Well, let me ask you a very quick question. Do you think your retirement savings are truly safe? I've been speaking to my clients over the last couple of weeks, especially since the budget, and they've spent their entire lives building up their pension, only to find out now that up to 67% of their fund could be wiped out in death taxes after they've gone. And then that, of course, naturally got me thinking about how many people in this community could be impacted by these new changes which were announced in the budget on the 30th of October. So at this stage, if you're unsure about what changes I'm talking about, then the recent budget has merged our pensions wealth within the IHT rules. And in doing so, it has turned our pensions into a financial trap which is threatening to drain the very wealth that we've all been working so hard to achieve. Now, as always, this isn't just about money, it's about your legacy, and it's under attack, make no mistake. And this video is going to help you make an informed decision about your future so you don't get caught up in this IHT trap. Now, there's going to be a lot of confusion as well as a lot of anger about these new changes, which have triggered some sort of a financial storm. So in this video, I'm going to explain the new pension rules as well as the inheritance tax rules, who's going to be impacted and who's going to be affected, and how you can avoid paying some of these exorbitant death taxes, and interestingly, who you can email to voice your opinion if you're against these changes. Welcome back to the Personal Finance Crew, and if this is your first time, a very warm welcome to the Economies channel, where together we're going to be learning the language of money and wealth, but we're also focused, dedicated and passionate about mastering money and making financial wisdom available to absolutely everybody. Hi, my name is Simon and I'm a chartered financial planner with over 30 years of practical experience based in the UK. So why don't you follow me back to the studio and we can get at this very complex and interesting topic together. So I'll see you in a minute. So let's make no bones about this. The recent budget has muddied the waters of retirement planning, especially when it comes to pensions and inheritance tax. Now, pensions are generally outside of the estate for inheritance tax, but since 2015, it's been possible to leave any unused pension to your beneficiaries, and this very quickly became very, very popular as part of both retirement and estate planning. Well, that is now at the very heart of a growing financial storm, with these proposed changes threatening to erode the very legacy you've worked an entire lifetime to build. So in the single stroke of a pen, the budget has created a pension as well as a death tax crisis, and one that could see families facing taxes of 67% and in some cases as high as 90% on their inheritance. So the questions that my clients have been asking me since the budget are pensions actually worth it anymore? And has this changed my retirement plan forever? Now, I'm going to be answering these questions in future videos, so please make sure you subscribe to the channel so you don't miss them when they're actually published. But I'm just curious to know, what would your answers be to those questions? Are pensions still worth it? Let me know in the comments below. Now, the budget has proposed a double taxation on pensions, as they're now going to be assessed as part of the inheritance tax regime from April 2027. Now, this is part of an overall £2 billion inheritance tax grab by the government, which also includes family farms. Now, I'm going to explain who's been affected by these changes, as pensions are now within the inheritance tax net and are going to be liable for a 40% tax charge. And many are calling this a spiteful double taxation hit that's going to affect many families up and down the UK. Now, pensions have long been a very tax efficient way to both grow and to transfer your wealth. Now, here are some magic numbers to remember throughout this video, and they're going to be 75, 40, and 67, and I'm going to explain why. Now, under the current rules, if you die before the age of 75, your pension wealth can be inherited tax-free by your beneficiaries. And since the lifetime allowance has been abolished, this means that if you had £2 million in your pension, there'd be no inheritance tax due to be paid. And what's more, any income withdrawn from that inherited pension would also be tax-free. So on death before age 75, there is neither an inheritance tax nor income tax to pay. Now, unsurprisingly, the government has considered that to be way too generous. If you die after the age of 75, there is no inheritance tax to pay, but your beneficiaries will pay income tax at their highest rate on any withdrawals. Let's try and put that into context a little bit. About 20% of the UK population will die before reaching age 75. Now let's have a look at our allowances. Now we each get an allowance of £325,000. And if we're leaving a property to a direct descendant, there's also an additional £175,000, making a total of £500,000 each. Now, I'm often asked, what if the value of my home is less than £175,000? Well, here is an explanation for you on screen from the government website. You apply the residence nil rate band to the whole of the estate, not just to the value of the home. So the whole estate benefits from this extra tax-free allowance. Now, we can pass on any unused allowances to a spouse or a civil partner only. Now, if you've been living with your partner, regardless for how long, you cannot transfer these allowances. This means that if you're married, you can have a combined estate of £1 million before you have to pay any inheritance tax. Now, these bans have been frozen for 15 years and they're going to remain frozen until 2030. The government is now proposing that pensions are to be assessed within the estate on death from April 2027. Now, assets that could be used inside your estate could be cash, savings or ISAs, premium bonds, for example, your main residence and any other properties, pensions, both your workplace pension and your personal pension, any investments that you might have, a business, and of course, all your personal possessions. A life insurance policy is also included if it's not written in trust. Now, these rules aren't yet written in stone, and there is a consultation live and in place until the 22nd of January next year. So if you want to add your voice against this move or to offer any alternative suggestions, please send an email to the address that's on screen. So if you've got an estate worth more than £500,000 or £1 million as a couple, then you're going to pay, and this is the next important number to remember, inheritance tax at 40% on any amount above this figure. So as I showed in the earlier media articles, once pensions are included in this estate, there's going to be a double tax to pay, as any withdrawals are also going to be subject to income tax, but at your highest rate. So let's have a look at a worked example based on an excess gain of £100,000. So inheritance tax at 40% means that regardless of what type of taxpayer you are, you're going to pay £40,000. This will then leave you with £60,000 in the pot, and then the double tax is then going to be applied when you withdraw the money, and that's going to be taxed as income. What that means is a basic rate taxpayer will then pay 20% or £12,000, and that would leave £48,000 in the pot. So by this point, you've paid £52,000 in tax, or a tax rate of 52%. If you were a higher rate taxpayer, you'd pay 40% income tax or £24,000. That would leave £36,000 left in the pot. That means you would have paid £64,000 in tax in total, and that's an effective tax rate of 64%. And an additional rate taxpayer would pay 45% income tax or £27,000, and that would leave just £33,000 left in the pension. So you would have paid £67,000 in tax, and this is the next magic number, or an effective tax rate of 67%. Now, what you need to remember here is, if you decide to take the inherited pension as a lump sum, this could take you into the next income tax band. So you're going to be paying tax at a higher rate. So please be very careful on the amount you withdraw and the shape of your withdrawals going forward. There are also some extreme cases where the residence nil rate band of £175,000 can be eroded for large estates above £2 million. And this extra amount is lost completely if the estate is valued over £2.35 million. And in these extreme cases, the combined tax rates in the UK can be as high as 90%. Just let that sink in for a minute. So what other problems can we foresee with these new changes? Well, one, what if you've got multiple pensions? Well, if you've got multiple pensions, the personal representative of the estate is going to need to get the up-to-date valuations from all the providers before an inheritance tax assessment can actually take place. Now, clearly, this is going to create a huge administration headache at a very difficult time for everybody that's involved. And any inheritance tax is going to be paid by the scheme administrators to the HMRC, but only after the inheritance tax bill has been agreed. What about late payment fines? Well, any estate needs to be settled and any inheritance tax needs to be paid within 6 months after the end of the month in which death occurred. So let me just say that again for clarity. Inheritance tax needs to be paid to the HMRC no more than 6 months after the month of the date of death. Now, the budget has also increased the late payment fines for inheritance tax to 4% above the base rate, which is currently 4.75%. So any late payment is going to be a very chunky 8.75% per year. So what about annuities? Well, there is an assumption that buying an annuity could be seen as a way to avoid some of the inheritance tax, but that's not always the case. As a general rule, if you buy a joint life annuity, there's going to be no inheritance tax to pay, because this is going to be seen as an extension of the deceased's income and not their estate. That means that all other types of annuity will be assessed for inheritance tax, especially if there's a capital guarantee or perhaps an income guarantee included in the annuity. So let me just explain that for you. Let's say you had an annuity with a 30-year income guarantee, paying £5,000 a year, and he died after 10 years. That means that an income of £5,000 would continue to be paid for a further 20 years, worth about £100,000. And it's that £100,000 which would then go into your estate and be assessed for inheritance tax. So before we get into the solutions to these problems, if you're finding value in this video, please hit the like button and subscribe to the channel, as well as hitting the notification bell so we can get this financial wisdom to as wide an audience as possible to continue to grow this very valuable community. We are on our way to 10,000 followers, so please stay with us on this journey. Okay, so let's have a look at some of the solutions. Well, number one is the 7-year rule. Now, you can withdraw as much as you want from your pension and then gift that to your family, perhaps as a lump sum. That means you're going to have to live for a further 7 years for this to be outside of your estate, but you're also going to have to pay income tax on these withdrawals. What about gifting? Well, you can also withdraw funds and then gift this money to your beneficiaries if this is a normal expenditure out of income. And that means your pension income, but not from your savings or your investments. So yes, as before, you're going to have to pay income tax on this withdrawal, but that's going to be lower than the double tax hit of inheritance tax and income tax. And you're also going to have to make sure you're not gifting too much, that you run the possibility of running out of money in retirement. So what about life insurance? You can use some of your pension income to buy a whole of life insurance policy on a joint life basis, paid on a second death to your beneficiaries, and then placed in trust. This means that on the second death, your beneficiaries will receive enough money tax-free to pay for any inheritance tax bill. So as this is written in trust, the payment's going to be outside of the estate for inheritance tax, and it's going to be paid a lot quicker, making the whole process a lot more streamlined. So just to reinforce this point, I got a quick life insurance quote today to illustrate this for you. Let's say we've got Mr. age 65 and we've got Mrs. age 60, and both of these are in good health, but they've got a potential inheritance tax bill of £40,000 as we worked through in the previous example. They could both take out a plan which would give their beneficiaries £40,000 tax-free to either pay the tax bill or to recover what they've lost from their pension, and that would cost them just £62 a month. So if Mr. dies first, there'd be no payout. But when Mrs. dies, then the £40,000 will then be paid out to the beneficiaries and the IHT bill can be paid. So if you want to know more about these types of solutions, let me know in the comments below. Now, I've included 2 other videos in this series to add some context to this video. One is about how to maximize your pension withdrawals, and it's called Drawdown for Dummies. And the other video is about balancing the very, very difficult inheritance tax tightrope. So thank you so much for watching to the very end and for your time and for your patience as always. And I'm going to see you all again next week.